Palo Alto Networks is an absolute cash-printing machine. I mean, it is easily one of the most brilliant software businesses operating right now. But here is the brutal reality. If you buy the stock today, the underlying valuation math suggests you might be staring straight down the barrel of a 38% downside. Right now, the market is demanding absolute, flawless execution from this company, leaving literally zero margin for error. So we're going to unpack exactly what's happening inside this cybersecurity giant, what the market might be missing, and what this business is fundamentally worth today.
38.6%. That is the massive potential downside risk hiding in plain sight against Palo Alto's $270 billion market cap. And you know, what makes this disconnect so fascinating is that this isn't a story about a failing company. Actually, it's the exact opposite. This is a story about a fundamentally elite business that's gotten trapped inside a really dangerous stock price. To understand why this tension even exists, we first need to look at how Palo Alto actually makes its money today, because their underlying economic engine has completely transformed.
If you still think of Palo Alto Networks as just this legacy hardware firewall company, you really need to update your mental model. When we look at their fiscal 2025 revenue mix, 54% now comes from cloud-based subscriptions, and another 26% comes from support. Put that together, and 80% of their revenue is highly predictable, recurring software and services. The actual product and hardware sales, that only makes up 20% of the pie now. They've successfully transitioned from selling metal boxes to running this massive, capital-light, recurring revenue engine.
So what's driving this incredible business? Well, it's a strategy management calls platformization. In the past, companies bought dozens of disconnected security tools from all these different vendors. It was expensive, and frankly, it was chaotic. Palo Alto's pitch is super simple. Consolidate everything with us. We'll cover your network, your cloud, your security operations, and now your identity. When a massive enterprise adopts this, they don't just rip it out overnight. That incredible lock-in secures 77% of the Global 2000. Plus, every new threat detected at one client instantly updates the defenses for everybody else. It's a brilliant data flywheel.
And they're aiming at a truly staggering total addressable market, $300 billion by 2028. To put that in perspective, that is roughly the GDP of New Zealand, but entirely dedicated to cybersecurity. Now, to capture this, they aren't just building everything in-house. They are aggressively buying their way to dominance. They just executed a massive $21.1 billion acquisition of CyberArk to secure non-human and AI identities, right alongside a nearly $3 billion acquisition of Chronosphere for cloud observability. This aggressive expansion is exactly how they're solidifying their moat against fierce cloud-native peers like CrowdStrike and Wiz.
So that brings us to the crucial point. If the business is this dominant, what exactly is the market so afraid of? Why is there so much tension around this stock? Well, the answer lies in the massive premium investors are paying right now. Look, when a stock is priced for perfection, the underlying business can't just be good. It has to be completely flawless. There's this deeply rooted fear that the stock's astronomical premium multiple leaves absolutely no room for integration hiccups or even slight execution errors. And you know, the latest earnings report gave us a very clear look at exactly what happens when brilliant top-line growth collides with the heavy costs of that expansion.
Let's look at the hard evidence. On June 2, 2024, Palo Alto reported their Q3 earnings, and the top-line numbers, they were absolute monsters. Total revenue hit $3 billion, up 31.1% year-over-year, easily crushing analyst expectations. Next-generation security annual recurring revenue, or ARR, exploded to $8.13 billion, growing over 60%. But then you look at the bottom line. A GAAP net loss of $177 million. That is a massive reversal from the $262 million profit they posted in the exact same quarter last year.
And this perfectly illustrates the crazy divergence in Palo Alto's profitability profile. On an adjusted non-GAAP basis, the company generated $684 million in net income. And that's what Wall Street usually focuses on, right? But the GAAP reality is much harsher. Why the massive gap? Well, because Palo Alto incurred heavy M&A costs and a staggering $500 million in stock-based compensation in just one single quarter. Investors took one look at the sheer costs of this growth and sent the stock down nearly 5% in aftermarket trading, and that's even though management actually raised their full-year forward guidance.
When we pull all of this together into a qualitative scorecard supported by the research, Palo Alto scores a blended 8.1 out of 10. The revenue quality is phenomenal, a solid 9 out of 10, driven by this massive $18.4 billion contracted backlog. And their market position, undeniably a 9 out of 10. But profitability drags the overall score down to a 6. Operationally, they are incredibly efficient, but on a strict GAAP basis, that heavy reliance on stock-based compensation to attract top engineering talent makes them technically unprofitable.
By the way, all of the research behind this explainer, including the deep valuation models we're about to explore, was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is always free. Now, if you want an ongoing investing edge, Flash does have a premium feature called Best Ideas Now. Every single week, it surfaces the highest conviction ideas across 3 different investor styles: long-term compounders, for quality businesses built to grow for years; hidden gems, for under-the-radar names with asymmetric upside; and dividend hunters, for durable income. Premium also includes Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, to track meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Just scan it to download the Flash app and try it out, or access it on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases.
Okay, let's dive into the valuation. Now, before we do, a quick reminder. This is a hypothetical framework for thinking about possible outcomes. It is absolutely not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. Oh, and by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed. All right, let's look at 3 possible futures for Palo Alto Networks 5 years from today.
Here's what the 5-year framework reveals. In our high case, where we assume massive AI cross-selling and perfect M&A integration, the stock essentially just trades flat, offering a tiny 1.1% return over 5 years to reach $367.88. In the low case, where integrations stall out and growth decelerates, the stock absolutely gets crushed down to $106.29. But the most important number here is our base case. We assign a 55% probability to this outcome, and it implies a future share price of just $229.50. Guys, that is a negative 36.9% return from current levels.
We need to unpack the logic behind that base case because it's so critical to understand. This scenario does not assume Palo Alto fails. Actually, scratch that. It assumes they wildly succeed. It assumes they double their revenue to nearly $24 billion and stabilize their free cash flow margins at an incredibly impressive 39%. Operationally, it is a huge success, but the killer here is multiple compression. The market is currently paying an astronomical premium for this hypergrowth. The base case assumes that over 5 years, as the company naturally matures, its valuation normalizes to a historically standard 35 times price-to-earnings multiple. So even with phenomenal business execution, the gravitational pull of a normal valuation multiple completely destroys shareholder returns.
So now we have 3 possible destinations 5 years from today. But there's another question, and arguably an even more fundamental one. The scenario analysis asks where the stock might trade in the future based on multiples. But what are the cash flows this business could generate actually worth right now, today? To answer that, we have to transition from a future scenario model to a present intrinsic value analysis using a discounted cash flow, or DCF model.
The intuition behind a DCF is pretty simple, right? A dollar generated 5 years from now is worth less than a dollar in your pocket today. So we project the future cash out, and then we discount it back to the present. Our operating engine starts with those base case growth assumptions. We're modeling management successfully scaling their free cash flow margins all the way up to 39% over our explicit forecast period. But we also have to account for reality. Because Palo Alto pays its engineers so heavily in stock, we are modeling a 1.5% annual share dilution drag to reflect the very real economic cost of that stock-based compensation. When we project this out over 10 years, the trajectory is amazing. The business is expected to generate nearly $15.8 billion in absolute free cash flow by year 10 alone. But when we apply an 8.72% discount rate, or WACC, to account for time and risk, the present value of that distant cash visually shrinks to about $6.8 billion. Summing up the present value of all the explicit cash flows generated over the next decade gives us just over $61 billion in value today.
But Palo Alto Networks isn't going to just randomly close its doors in year 10, right? The business will keep operating. So we have to calculate the terminal value, which is the value of all cash flows from year 11 into perpetuity. Assuming a conservative 4% perpetual growth rate, which makes total sense for a durable cybersecurity moat, the present value of the terminal value is estimated at $151.4 billion. Notice how massive that is. Because of their incredibly sticky platform, the cash flows generated way out in the distant future make up the vast majority of the company's overall enterprise value today.
So let's build the valuation bridge step by step so you can intuitively see exactly where the final intrinsic equity value comes from. First, we take the present value of our 10-year cash flows, which is about $61.38 billion. Second, we add that massive present value of the terminal value, the $151.48 billion. Third, we add in the net balance sheet adjustments, like cash minus debt, which gives us a positive $6.36 billion. And finally, we divide all of that by their 835 million diluted shares.
And that math leads us directly to a base implied intrinsic value of $262.56 per share. That represents a 38.6% downside from the current trading price. Now, it's super important to understand the sensitivity here. If we lower the discount rate slightly and assume higher terminal growth, the value pushes up toward $330. But if we raise the discount rate and lower growth, it drops under $200. The reasonable range, however, sits firmly between $220 and $285 per share.
Let's explicitly reconcile these two frameworks side by side, because this is where the real insight happens. Our 5-year scenario tells us the stock could trade at $229.50 in the future based on multiples. Meanwhile, our DCF tells us the cash flows are worth $262.56 today. Notice that the DCF value is actually higher than the future scenario price. Why? Because Palo Alto converts 39% of its revenue directly into free cash flow. A cash discounting model rewards that kind of sheer efficiency way more highly than a compressed PE multiple does. But the crucial takeaway is that both lenses are telling the exact same economic story. Compared to the current $363 price tag, the market is demanding flawless execution with zero margin for error.
And this brings us to the core disconnect. The business is brilliant, we know that, but converting 39% of revenue to cash is one thing. Buying the stock at 96.3 times forward-adjusted earnings is historically dangerous. To justify this current price, you have to believe that the market will permanently grant Palo Alto a massive premium multiple forever, completely ignoring the gravitational realities of mature software companies. The underlying valuation math simply offers no margin of safety for the investor.
And look, when you have no margin of safety, you are entirely exposed to structural risks. So what could break this thesis? First, there's massive integration risk with swallowing a giant like the $21.1 billion CyberArk deal. But the most interesting hidden risk right now is legal. A subsidiary, Meeting TV, is facing a high-profile, precedent-setting lawsuit for allegedly generating hallucinated AI threat intelligence. A defeat in October 2026 could establish severe liability precedents for the automated AI scoring that is literally core to Palo Alto's entire future narrative.
So what exactly should you be paying attention to? The early warning signs that our 5-year scenarios and DCF assumptions are breaking down are very specific. You need to watch next-generation security ARR growth. If that organic growth dips below 20%, the multiple will almost certainly contract violently. Similarly, keep an eye on their non-GAAP gross margins. If they slip under 72%, it signals that competitors like CrowdStrike or Wiz are forcing them to cut prices, which would seriously degrade that beautiful free cash flow machine we just modeled.
To wrap this all up, Palo Alto Networks has undeniably established itself as the definitive cybersecurity platform of the digital era. Their transition to a recurring model is a massive triumph, and the data network effects are incredibly real. Operationally, they just need to execute these massive integrations flawlessly to justify the narrative. But from an investment perspective, what we've seen today is that both our future multiple-based scenarios and our present cash-based intrinsic models point to the exact same reality. This is a fundamentally elite business, but it's trapped inside a dangerous stock price. The underlying valuation math demands extreme caution.
If you want the full research, including the complete 5-year scenario model, all the probability weightings, and the detailed intrinsic value analysis behind this explainer, you can get it completely free right now at flashstocksentinel.ai. So the ultimate question remains, are you willing to pay a flawless price for a company operating in a highly flawed world? Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.